Yes, sir.
Yes, sir.
Yes, sir.
So, the topic for today's webinar is behavioral finance, and basically it is a curtain raiser. And what I have been told that this will be a group of the participants will be basically students, UG and PG, and some research scholars. But now I could find that there are some senior people also in this webinar. So accordingly, I will be trying to meet to the expectations of both the group students as well as the researchers and some of the senior people, and at the end let me see to what extent I will be successful in doing that. So behavioral finance, it has caught the attention of the media as well as the scholars and the academicians way back in 2002, when for the first time Daniel Kahneman has got the Nobel Prize in economics for his work on prospect theory. At that time also it was not getting that much of the momentum, but especially in the year 2017 when Professor Richard Thaler had got the Nobel Prize for his work on nudge theory, and then all of a sudden people have started talking about behavioral economics and what exactly is this behavioral economics, and so on and so forth. So today we shall be just trying to explain what exactly is the behavioral finance and what are the things and what are the areas we are studying in this behavioral finance, how it is different from the traditional finance, and is it a supplementary to the behavioral finance or it's a substitute to the behavioral finance. So these are the questions that we'll be addressing in today's webinar. So I will start today's session with one story. There is one scenario. There are two persons, Rakesh and Chandni, and they got married and they went for honeymoon. So after marriage, normally people go for the honeymoon, and the place they have decided to go at Las Vegas. And you know that Las Vegas is a place which is known for casinos, famous for the casinos. And Rakesh and Chandni, they are very much disciplined, and they have decided that they will be spending not more than $1,000 on casinos. If they will win, they will continue to play, and if they will lose, so the maximum loss that they will be bearing is $1,000. So they are very disciplined, they are very educated, both of them are MBA finance, and they know how to make budget and how to plan their journey, and everything they have decided well in advance. They are very disciplined, and ultimately they stick to their discipline, that they had not spent a single penny beyond $1,000. So sometimes they won, sometimes they lose. And one day what happened, when they were playing in the casinos and they had lost entire $1,000. Definitely this was a loss, and losses gives pain. So Rakesh came to the room, in the hotel room. Their room was upstairs in the same hotel where the casino was located, and he was just sleeping. He was not very happy, because on that day, though whatever the discipline or whatever the commitment or the promises they had made for themselves, but ultimately they have lost money, and as you know that losses gives pain. So he was not happy, he was not in a good mood. And when he was sleeping, and he under the mattress he found some coins, and he took out those coins, and all of a sudden he told his wife that let me go downstairs, I'm just coming within a few minutes. And he started playing gambling. He went for the gambling, and that day his luck was with him, and he had started winning, and he won sizable amount of around $10 million. From $10 he continued to play, and whole night he had played, and ultimately he was able to won $10 million. And ultimately the owner of the casino told that, sir, the limit of our casino is only this much, and beyond that we cannot accommodate you, and if you want to play further, we can arrange one car for you, and you can go to the next casino, which is a relatively bigger casino than this, and you can play there. He agreed, and the taxi was called, and he went to the taxi, he went to the nearby casino, and he started playing. And that day he thought that today is my day, and definitely I will be winning, and let me try my luck. And ultimately he lost all this $10 million. He bet this entire $10 million thinking that if I won, today I will become a billionaire. But ultimately he lost the entire money. And then he is coming back to the room. And while he is coming back to the room, his wife opened the room and just his wife asked, what happened, honey? And did you went to casino? Seems you lost money. How much did you lose? And Rakesh entered and yes, darling, but I lost only $10. His answer was, I lost only $10. Now this is a question to ponder upon. How much is the actual loss? Was the loss is actually $10 or it is $10 million? A few minutes back, if he would have stopped playing, he could have $10 million. He would have been one of the richest person in that hotel and he could have been back to his home with that $10 million. But he is consoling himself that he had lost only $10 million. Now this is a question need not to answer, but just think, how much is the actual loss? Is it $10 million or is it $10 only? Okay. The problem is just the point of reference. From where are you thinking? If you're thinking that a few minutes back he had $10 million, a few hours back he had only $10. How much is the actual loss? That is a question to think upon. Let us go to the another scenario. There are two friends, Subodh and Suraj. Both of them were graduated from one university, say MBA, and ultimately both of them have been placed in some reputed companies but in the same city. And both of them have decided that since we are school friends, since we are the friends from the childhood and we are working in the two different companies, so let us meet together at least once in a week and we will just have some juvenilization and we'll party in once in a week. Both of them have agreed. So let's have a party every month and we'll pay alternative. And this was decided that we will pay alternatively each month, every month. That is, in 1 month Subodh will pay, next month Suraj will pay. So the party will go on in this way every month. In 1 month Subodh will pay and next month Suraj will pay. And in the first month they had the party and the bill was rupees 3,000 and was paid by Subodh by credit card. Fine enough. Next month again they had the party and the bill was of approximately 3,200 and was paid by Suraj by swapping the credit cards. That was also fine enough. Not a problem. And in this way the party continues for several months and they used to pay the bill by swapping their credit cards. Okay. One particular month it was Suraj's turn to pay the bill and suddenly he discovered that he forgot to bring his credit card. And Subodh said that, should I pay the bill? No, I have the cash, so I will pay the bill by cash. And he paid the bill by cash. Next month, Suraj, I am no more interested in this kind of party. Why? Are you angry with me? I think we are spending too much on unnecessary items. This is the realization of Suraj. After partying for several months, he had understood that we are spending too much on unnecessary items every month. 3,000. Now 3,000 is not that big amount, but this story is, suppose if it is of the year 2000, when I was just graduating in the year 2000, and at that time 2000 for a lecturer the pay scale was only 8,000 rupees. So out of 8,000, if someone is spending 3,000 rupees per month just on a party, then that was an unnecessary item. And the question is, again this is a question just to think about what makes Suraj feel so. Why? So long as he was paying by the credit cards, it was absolutely fine. But the moment he had to pay the bill by cash, then he all of a sudden he started thinking that we are spending so much on unnecessary items. So what is so special about that? So this is another question just to think about it. Why actually Suraj is thinking in this way? Let us come to the story number 3. One person, he has decided to go to cinema hall, and the moment he was able to enter into the cinema hall, and he had discovered that he has lost the ticket which was worth rupees 200, and the question is, what should I do now? And another situation is that a person was about to enter into the cinema hall, and a note of rupees 200 which was kept in his pocket was lost. The question is, should he buy a ticket now? In the first situation, he had lost the ticket of that particular movie which he wanted to see, and in the next scenario, he had lost a note of rupees 200 which he kept in his pocket, and the question is, should I buy the ticket now? The things to ponder upon: are both the losses equal? A loss of ticket which was worth rupees 200 and a loss of rupees 200 note, currency note, both the losses are, in terms of monetary value, they are equal, but will they be treated similarly or likely by the same person? The answer is not exactly. There is a probability that if the person who has lost a cinema ticket and will be buying again another cinema ticket is only 10%, but the person who had lost a currency note of 200, and what is the probability that he will buy a cinema ticket is almost 80% chances are there. There is already one study that 80% chances are there that he will buy another movie ticket. Now why? This is also another question. Now we have, having understood or having listened to all the three stories, story 1, 2 and 3, all are related to money, and we have understood that the persons have reacted differently on different losses, on different financial transactions, on different occasions related to, or different decisions that they had taken related to their financial transactions or the investment part. And the reason is difference in their learning which they had gone through with that particular experience, and then change in their attitude and the personality and the perception. So the learning, attitude, personality and perception of a person have affected their decision to make a particular investment decision or to make a particular financial decision, and all these things are actually studied in psychology. Then another important thing is the social environment. A person who is residing in a particular environment, say in South Africa or in some of the countries of Africa, his social environment or her social environment, a person who is brought up in New York or Tokyo or a place like Mumbai, that person's social environment will be different. So accordingly, the learning will be different, and there is a theory by Albert Bandura, social learning theory, that the people or the person, they used to learn from the surroundings they are residing. So the learning will be different, as I just stated earlier. So the social environment have an impact on the decision people take with respect to their finances, whether it is a spending decision or investing decision or financing decision. Then culture have an impact on the decision people used to take. For example, this is the example very often I quote, that there are certain cultures in our country or like in this world, like where investment in a certain security which actually deals with the interest is considered to be haram, that is prohibited. Especially I am talking about this Muslim culture. So that the dealing with the interest is considered to be haram, that is prohibited, and that's why if someone is believing in, is from that particular culture, and how profitable that company is, that should suggest that okay, you invest in a company like a State Bank of India, this is a very profitable company, but simply because of their culture and their mindset, they will not invest in that company because their religion and their culture have prohibited from doing that. So this is just opposite to this rational behavior, that we have been taught that human being is behave rationally, and we behave rationally and always we are optimizers, but here culture is coming in their way. Then social class, from which social class they are coming to. In Assam, there is a concept of Schedule 6. So the person who is from the Schedule 6, they are not required to pay any tax. And since they are not required to pay any tax, they are not making their PAN card. And since they are not required to prepare their PAN card, so the moment they are going to open up their demat account in some of the depository participants, and for opening up a demat account to deal with the share market or to invest in the stock market, demat account is mandatory, and for opening a demat account, PAN card is mandatory. And since they belongs to a Schedule 6 community, so PAN card is not mandatory for them. So if it is not mandatory, voluntarily they have not prepared PAN card, and that's why they have not invested in the stock market. This is one of the biggest limitations. So the biggest benefit that is given to them, sometimes it turns out to be the biggest limitation, that they are not investing in the stock market, not because they are not aware of stock market, but because they have not prepared their PAN card. And since why they have not prepared their PAN card? Because it is not compulsory for them. So until and unless the things are made compulsory, they will not go for that, and ultimately they will not be investing in the stock market simply because of their social class. And all these things are studied in sociology. Then history is important. Why we are behaving in a particular way? So we had a history behind us. Why some other people are behaving in a different way? They had a history. So why certain communities are very prosperous, certain communities are very adventurous or enterprising community? There is a history behind them. So, and the evolution is there, that actually we study in anthropology, and the economic system or the economic status have an impact, and that is economy. We study economics. So economics or economic system, basically we have two types of economic system in the world. Two extreme, one is the market economy and another is the command economy. So what kind of decision we'll be taking, that depends upon what kind of economic system we have. For for the students who are beginner, let me clarify you that economic system means the certain institutional arrangement within the economy through which the entire economy functions. So there are two systems: market economy, where consumer is the king and individuality is respected, and whatever you want you can produce, and whatever you want to consume you can consume. So that is the absolute form of market economy. Command economy, that is the basically communist economy. Everything will be dictated by the government. So that is command economy. So two economic systems we have. And what kind of decision we'll be taking, to a large extent it depends upon what kind of economic system. Today we have a petrol pump of Reliance, and alongside the petrol pump of Reliance we also have the petrol pump of Bharat Petroleum or Indian Oil Corporation. This we are able to see because we have adopted an economic system of mixed economy, that public sector and private sector, both of them will be staying together. We have the telephone lines of BSNL, which is a public sector, and along with BSNL we are also using Reliance Jio or Airtel. This is because public sector and private sector, both of them are existing together. So the decision we are taking, whether we will be going with the public sector or private sector, that depends, that certain decisions the policymakers have taken at that time, at the time of our independence, that we will be going with the mixed economic form of economy. And that's why we have the coexistence of public sector and private sector, and the decision we are taking is primarily because of that economic system we have. And what kind of economic system we will have, that is largely governed by the political system. Prior to 1991, though we were the part of the non-alignment movement, India was a part of the non-alignment movement, but our policies, our economic policy and foreign policy, everything was slightly skewed towards the USSR. But after the demolition of USSR, the world becomes unipolar, and the kind of political party that came into the power, that was slightly skewed towards the market-driven economy, and we had seen the economic policy of liberalization, privatization and globalization. So that LPG policy, that economic system, that liberalization, privatization and globalization we had, that was primarily because of the political system we had in 1991, that Mr. P.V. Narasimha Rao was the Prime Minister, and he had adopted a policy of LPG, and it was primarily because of his willpower he was able to do that. So that political system, then what kind of accounting will be having, whether will be the kind of accounting principles we have, that is also because some impact is there of the culture of that country. Like we used to follow LIFO method, FIFO method, Americans used to follow LIFO method. Primarily some part is because of the culture. We used to value stock on the basis of we used to charge depreciation normally on written down value method, because in written down value method the value of stock, the book value of that particular asset will never be zero. It will have some value at every time, because we Indians believe the things can be repaired also, and we have taught to the world that the things can be repaired also. Whereas in USA it is a straight line method, that if a particular asset is there, life is 5 years, after 5 years just throw it away, bring another asset. So that's why they are charging on a straight line method. So what kind of accounting policy will be having, what kind of managerial style will be having, and all these things have an impact on our decision that we are collectively taking. And all these things, psychology, sociology, anthropology, economics, political science, accounting, management, everything is collectively studied, and the impact of all these things are collectively on investment decision are collectively studied in a discipline called behavioral finance. So we have seen that the kind of decision, just with the stories that we have seen, the 3 stories, that kind of decision we are taking, not always based on the rationality, that we are not always optimizers, we are not always going with the best decision or the rational decision, rather our emotions, that psychology or sociology, from which social class or culture or what kind of surroundings we had, and what is our history and what kind of economic status we have, everything have an impact on the decision people take with respect to their finances, whether it is investment decision or financing decision or dividend decision or any kind of spending decision. So that is collectively studied in an area called behavioral finance. Now the question is it different from the traditional finance? Definitely it is different from the traditional finance. How? So just now we have seen that in traditional finance there are certain assumptions. So the first assumption is that people process data appropriately and correctly. But just now in the case studies or the 3 stories that we have listened or we have just gone through, we have seen that people, they do not process data appropriately and correctly. Besides the data, the lot of emotions actually prevail, which prevents them in processing the data appropriately and collectively. Then in behavioral finance, we believe that people employ imperfect rules of thumb, heuristics, to process data, which includes biases in their belief and that predisposes them to commit errors. People view all decisions through the transparent and objective lens of risk and return. Whereas in behavioral finance, we believe that perception of risk and return are significantly influenced by how problems are framed. So how the decisions are framed, how the problem is actually being presented to the decision makers, that have an impact on the decision people have to make. Okay, like before, in the first decade of this 21st century, when India and Australia used to play cricket, so India used to play with an intention of not to lose, whereas the Australia used to play with an intention to win, that playing to win and playing not to lose. So these are the, someone have opened the mic, please mute their mic, it is creating disturbance. So playing to win and playing not to lose, these are the 2 decision problems. Ultimately both of you will see that both of them are the same thing, but ultimately how the decisions are framed, that have an impact on the attitude of the people. So investment in a particular stock, investment in a particular asset, not only stock, any kind of assets, so how the things will be presented. One thing is that if I invest in this particular asset, the chances of return are this very high, pretty high. And if I invest in this particular asset, the chances of risk are very high. So what actually I am seeing, whether I am seeing the risk part or the return part, that have an impact. So how the problems are actually framed. One very popular story or story that normally I used to quote at this point in almost all my seminars, that of a king who has seen a dream, and in his dream he has seen something, and ultimately he has narrated the story, narrated his dream to all the persons in his assembly, and asked if anyone can interpret that dream, that person will be rewarded significantly. One person came, he has gone through the entire story, that the dream that the king have saw in that particular night, and he said that you will see all your family members dying in front of you. King get offended. How dare you to say all these things, rubbish things to me, that I will see all my family members dying in front of me? Just put him in jail. So that person was sent to jail. The son of the wise person, he was also a great astrologer. He came to meet the king, and he said that I can also interpret your dream. Let me try. King said, but be aware. Just you have seen that someone have tried to mishandle my dream, and ultimately he was sent to prison. He said, don't worry, king, I will take care of it. So he has also listened to the entire story, and he said that his majesty, you will be the longest surviving person in your entire family. King was happy. Yes, Mongembo खुश हुआ, बोलो क्या चाहिए? I don't need anything, just you release my father who is imprisoned yesterday, and just to release him. King just released him, and he just took his father, he went away. The persons in his assembly asked, King, what is the difference in the two interpretations they had? Both of them have given. King was asking, well, ultimately, both are saying the same thing, that you will be the longest surviving person in your entire family. It means that all of your family members will die in front of you. That is the same thing. But ultimately, how the problems are presented to the people, that makes the difference, and that makes the difference in the decision. So that is a behavioral finance, how the problems are actually framed. And when you will got to understand or got to study some of the theories in behavioral finance, like prospect theory. This entire prospect theory is based upon this framing of the problem, framing of the decision problems, how the decision problems are framed, whether it is framed in the context of losses or it is framed in the context of gains, and the decision just gets changed. People are guided by reason and logic and independent judgment. That is the assumption in the traditional finance. But just now we have seen in all the three stories that emotions and the herd instincts plays an important role in influencing their decisions. So it's not always the reason, it's not always the logic, rather it is the emotion that plays a most important role in influencing the decision of the people. Then we believe that markets are efficient. Market prices of each security is an unbiased estimate of its intrinsic value. This came up with the theory of Eugene Fama in the year 1970. He came up with a paper of that called efficient market hypothesis, and where in efficient market hypothesis he has assumed that he has given a hypothesis the markets are efficient, and whatever the prices are there of a particular asset, those prices actually reflect the correct price of all the informations which are available with respect to that particular asset. So all the informations are discounted. It means that there cannot be any undervaluation of a stock, there cannot be any overvaluation of a stock. So markets are efficient, and if there are no undervalued security or no overvalued security, then there cannot be any technical trading in the market. That is the belief, or that is the assumption by using Fama, and that is given in the efficient market hypothesis. But the kind of fluctuations we have seen in the stock market, every day it is fluctuating, it is touching a new height. It is just simply a testimony of the fact that the markets are not efficient. So the markets are not efficient, that is in the traditional finance, whereas in the behavioral finance, it is the heuristic driven biases. There are certain errors, frame dependence, how the things are framed. It depends on that also. Effects of emotions, social influence often led to the discrepancy between the market price and its fundamental value. So this is just in brief how the traditional finance and the behavioral finance, both of them differ with each other. That is difference in the assumptions. Now the question is, why the need for behavioral finance? We had so much of the theories, we had so much of the research in the area of economics. In 1776, Adam Smith, who have wrote the first paper on an inquiry into the wealth of nations. So since 1776, we had a study, we are studying behavior economics, lot of theories in the area of economics, later on the area of finance we had. But still, why we need to have a separate branch called behavioral finance? Why we need to study emotions? Why we need to study psychology along with the finance? There is a question. And the question is, we had seen several crises, not only the Great Depression of 1929, rather several crises, Mexican crisis, the currency crisis of East Asia in 1997, the great financial crisis of 2008, so many crises we had seen. And just now I mentioned that we are in the West, officially we are studying economics since 1776. And since 1776, we are studying economics, we are studying finance, but none of the theories, none of the studies were able to predict any of the crises. Whether it is the Great Depression of 1929 or the Great Financial Crisis of 2008, none of the experts were able to predict this crisis situation. Lot of banks went bankrupt. The Great Financial Crisis of 2008, it started with the bankruptcy of the Lehman Brothers. Then other companies also in the year 2001, like Enron Incorporation in USA, and then WorldCom, they have been filed for the biggest bankruptcy in the year 2002. So they also got bankrupt in the year 2000, and lot of bankruptcy cases in India also. We are seeing so many bankruptcy cases. Even Satyam Computers, one case was there. Interestingly, here also, none of the models, none of the financial models were able to predict that, okay, this is a sign of bankruptcy and this particular financial institution or bank or a company is going to be bankrupt because of such and such things. The stock market crash, we had several crashes, and if we just look at the data just before the stock market crash, all the economic indicators, all the experts were very much optimistic that the market will be touching new height, and all of a sudden market starts falling, and all the economic experts, the same experts, they start predicting that now there is no hope and the market is going to down further, down and down. So once the market is going up, everybody will be predicting a new high, and when the market will start falling, everybody will try to predict a new low. But the question is, nobody is able to time this market, whether it will be when actually it is going to fall and when it is going to have a U-turn or V-shape recovery. Nobody is able to predict or to time this market. And we are claiming ourselves that we are studying economics and finance for the last 1776, especially in Europe and in that modern context. We have so much of the theories. So all these theories, they fail to predict or provide solution to this crisis or bankruptcy or the stock market crash. And this is the reason then that we need to study our emotions, because what actually had happened in Satyam Computer is not the rational behavior of human being, but ultimately it's the greed. It's the ethical part which we are not studying in finance. In crisis or in the stock market crash, we have to study the psychology of the people, the emotions of the people, the sociology or the historical background of the people. Something happened in USA and all of a sudden the Bombay Stock Exchange starts falling. Why? The people have stopped consuming, or the factories have been closed. All the managers or the CEOs of the companies in India, are they died? Are they going to die or they died? Nothing had happened in India, but something happened in USA or something happened in some Middle Eastern countries, and there are certain companies which are not at all related to USA or Middle Eastern countries or Afghanistan, but their stocks will start falling down. So it means that the rational human behavior, or that is the fundamental assumption in almost all the economic theories, that is not tenable. And ultimately we need to study psychology also along with that, the traditional finance or the traditional economics, which have certain assumptions. We'll come to those assumptions also. So that's why we need to study behavioral finance. So the question is, why traditional finance failed, and why we have failed, all this traditional finance have failed. And one reason, one answer that is coming, unanimous answer, is that this unrealistic assumptions of all those theories, whatever we are talking about, whether it is the theory of law of demand, supply, or marginal utility theory, or in finance CAPM model, or arbitrage pricing theory, or Markowitz model. So many models are there, so many theories are there, but ultimately if you just go into the assumptions of all those theories, you will find that most of the assumptions are unrealistic. First unrealistic assumption, that market participants are rational. And if the participants would have been rational, there won't be too much of the fluctuations in the stock market. Why market participant? What is rationality? That everybody will be trying to maximize their benefit, and everybody will be making the best decision that is for them. And I'm just giving one example, that if I'm holding one share of, say for example, that particular stock is, I'm not trying to endorse that stock, just for example, I'm thinking I'm having one stock of Tata Steel Limited. I just bought one Tata Steel, and I think that this Tata Steel is one of the best stock. It's a very good company, and definitely I should hold it. And the same information is with the other person also. He also wants to hold Tata Steel, but the problem is, I also believe that Tata Steel is a good company, and that person who wants to buy Tata Steel, he also knew that Tata Steel is a good company. But since I believe that Tata Steel is a good company, I will not be selling that. So if I will not sell, that person cannot buy. So it means, if I am rational, I will not sell Tata Steel until and unless compelled by certain extraneous, some external factors, like I need money because of some other reasons. I will not sell Tata Steel. I will not sell Tata Steel simply on the assumption that, okay, I have made enough money and now it is a very profitable opportunity. I am getting very good price and I should sell it. I will not sell. And if I will not sell, that person cannot buy. And if I will not sell and that person cannot buy, it means there will not be so much of the trading in the stock market, or there will not be so much of the trading in any market. Forget about the stock market. People are buying flats, people are buying real estate on an assumption, with an assumption that today I will invest in the real estate, and tomorrow when the prices will go high, I will sell it. It means that the participants are not rational. This again, we are not rational. Does it mean that we are irrational? We have gone through this slogan, that boycott Chinese product. And if we just go with the theory of this rationality, again, what is rationality? That will be making the best decision. And if I wanted to buy a phone, I will be buying a telephone. So just for example, I am just giving you that if I want to buy a mobile phone, I will be buying a mobile phone which will be having the best features at the less prices, or at the least prices. And definitely this kind of combination is given by most of the Chinese phones. But we have been given this mantra that boycott Chinese product. And if we are boycotting Chinese product, then howsoever good that Chinese mobile phone is, I'm not going to buy. Does it mean that we are irrational? So nobody would like to be called as irrational. So rather, that rational terminology is, our rationality is biased. We are having a biased rationality. Okay. Another assumption, investors take care of all the available options. So just replace the word investors and just replace the word investor with the market participants. That participant can be the buyer or seller or the intermediary, can be anyone, and they take care of all the available options. But the question is, do we take care of all the available options? Just take an example. Suppose this is a boy and he wanted to marry, and if he wanted to marry, and for him all the available options for this particular boy are all the girls in that particular age group in this universe, in this entire globe. And suppose this boy is of 25 years old, so definitely he will be looking after marrying a girl who will be within the age of 20 to 30 years, and within 20 to 30 years there must be approximately 150 crore girls all around the globe. And if he used to take care of all the available options, if you have decided, okay, I will meet all the girls on the globe and then I will decide to marry who is better suited for me. Or similarly, this is just for opposite gender also. If a girl decides to marry a boy of a particular age group, and that she just thought to meet all the persons on the globe, ultimately she have to meet 150 crore number of people approximately, and ultimately the result will be that person will never be married, because to meet 150 crore people on this globe is practically impossible, because on an average our life is of a person's life is approximately 3 lakh number of days. 3 lakh days. So that is from the birth to death. And if we start meeting every single day another person, at the most we can meet only 3 lakh people. We are not able to meet even 1 crore number of people, and we are talking to marry meeting 100 crore people. So ultimately that person, whether boy or girl, will never be married in his or her lifetime. So that investors take, or the participants take care of all the available options, that is not tenable. Similarly, in the stock market, just take the example of Bombay Stock Exchange. There are around 8,500 number of securities listed in that BSE. And if an investor have decided to invest in a security, and he has decided to that he will be screening or she will be screening all the 8,000 number of securities before making his or her investment decision, ultimately the chances are that he or she will not be making investment in any of the companies, because that will never be complete. So there are thousands of securities. So what actually we do? We do screen a limited number of securities, limited number of options we normally use to explore and scan, and based on that we used to take decision. That is the reality. But the traditional economics and finance model, they assume that investors, the market participants, they take care of all the available information. So this is second unrealistic assumption. Then the third unrealistic assumption, whether in all the traditional economics model is there or in even modern financial models or theories are there, that the perfect market. And the perfect market means homogeneous product, free entry and exit, perfect knowledge of prices and technology, no transportation cost, no artificial restrictions, large number of buyers and sellers. These are the assumptions, these are the features of perfect market. And you know that those who have studied economics, you know that this perfect market, it rarely exists. It exists to some extent in agriculture, but so far as in this organized competition, organized marketing is there, this perfect market, it does not exist. So this is just a theoretical concept, it does not exist. And interestingly, most of our theories, they are based on this perfect market assumption. Resources are allocated efficiently. This is also another unrealistic assumption we used to have in almost all our theories. So ultimately we have so many theories of traditional finance, that is efficient market hypothesis, modern portfolio theory, asset pricing model, CAPM model, expected utility. So many dividend theories are there, valuation theories are there, all these theories are there, and in almost all the theories, All these unrealistic assumptions are there, and that's why in spite of having so many theories in traditional economics and finance, we are not able to predict the future of our globe in respect of financial decisions or financial outcome. We are not able to predict that, and that's why we need behavioral finance. Okay. If we just divide these decisions based on the rationality and irrationality, so ultimately we'll have, yes, so we'll have four decision situations: that rational man making a rational decision, rational man making irrational decision, irrational man making rational decision, and irrational man making irrational decision. If you just divide it based on the rationality of a person and the behavior of the person, rational behavior of the person, and we'll find that in the traditional economics and finance, we actually study only this situation, a rational person making rational decision. This is the only situation we used to study, and the 3/4 of the situations are actually not being studied in any of the models or the theories of economics and finance. And here lies the importance of having another discipline called behavioral finance, which ultimately study all this rationality and irrationality, rational behavior, irrational behavior, or the biased rationality, bounded rationality. All these things are actually studied in a discipline called behavioral finance. Now come to the definition of behavioral finance, that the premise of behavioral finance states that by considering psychological factors into account, the effectiveness of investment strategies can be enhanced. And the behavioral finance is a branch of study that uses the psychological based theories to explain market anomalies. So this is once again, now coming back to the history of behavioral finance, what actually is the history of behavioral finance? So just now I have taken the name of Adam Smith, who is also known as the father of economics and one of the pioneer economists in the classical period. So during the classical period, economics had a close linkage with psychology. It is proved in some of the writings of Adam Smith that economics and psychology were closely related during the classical period. 1776, his paper on an inquiry into the wealth of nations, an inquiry into the nature and causes of wealth of nations, that was published in the year 1776. And at that time we had seen that economics and psychology were closely related in this particular research paper. Some of the famous classical economists of the West, Adam Smith, Jean-Baptiste Say, David Ricardo, Thomas Robert Malthus, and John Stuart Mill, they are some of the famous classical economists of the West. And if you just go into like whether it's a Ricardian theory or the John Stuart Mill's theory or the Malthus, ultimately you'll find that this psychology, economics, and sociology, they are not treated in as independent discipline. They are actually studied together. It means that psychology or sociology and economics, they were studied together. They were actually studied during the classical period. Just go through this, one of the writing of John Stuart Mill, that logic comprises the science of reasoning as well as an art founded in that science, the science of logic. And the system of logic is concerned with the right method of thinking for constructing a science of human nature, and that would include psychology, sociology, and economics. So even John Stuart Mill have included psychology, sociology with the economics. But during this neoclassical period, after this 18th century, economists, they just started to distance themselves from the psychology, and it was primarily because they sought to reshape this discipline as a natural science. They started to believe that economics is an independent science and it have an independent status, and it should not be mixed with the psychology. Psychology is different, economics is different, sociology is different. That was the thinking of the economists of during this neoclassical period. And during this neoclassical period, the importance of this rationality, rational human behavior was emphasized during this neoclassical period. So some of the neoclassical theories are given in this slide. You can just go through it. Rational agent, perceived value, saving drives investment, free market, market equilibrium, relevant information, marginal utility. And some of the economists are like Alfred Marshall, John Bates Clark, Irving Fisher, and Wilfred Pareto were some of the economists during this neoclassical period. Some of the neoclassical finance model, many of you have already studied in your MBA classes, like option pricing and CAPM model, portfolio principle of Markowitz, then Modigliani and Miller arbitrage pricing principles. All these things are actually the outcome of this neoclassical financial uh, theory. Now, the modern economics, psychology, during this modern time, psychology had largely disappeared from the economic discussions, and that's why you'll, in almost all the economics discussions, you will find the recent research papers, pure economics, you will find there is no role of emotions and psychology and sociology. Expected utility and discounted utility models began to gain wide acceptability, and the model based on rationality of participants, they are actually um, getting importance day by day. Now the question is, this was about the West. Now what was India or the Bharat at that time doing? And we have seen that in the West, the economic started in the year 1776. Like Adam Smith is the father of economics in 1776. But in India, we had Arthashastra, which was written 300 BC. That is 2300 years back. Arthashastra, that is by Kautilya, and another name is Chanakya. So Chanakya, basically he was a professor of economics in the University of Takshashila, which is now in Pakistan. So he has written the Arthashastra, and this Arthashastra is a close knit of political science, public administration and economics. If you just go through this entire writings of Arthashastra, economics, you will find that political science, public administration and economics are actually studied together. They were not studied as an independent discipline. So during the period of Arthashastra also, this economics was not treated as a separate discipline. That is in the year 320 BC. In the 326 BC, Alexander invaded India, and after that he has his book on Arthashastra, his book named Arthashastra, not Arthashastra, his book Arthashastra that came into picture. In India, we have 4 objectives of our life: dharma, artha, kama and moksha. And this artha is not, that is, artha means the money is not independent, it's not compartmentalized that only you have to earn money. This artha is along with the dharma and karma, dharma and kama. So dharma and kam, that will be there along with the artha, and then only we have to make a sustained living. Dharma is the duty or charity or worship or self-actualization. These are the 4 meanings of dharma, and along with this dharma we have to practice kama, and we required artha also. So finance was never treated as an independent discipline in India since the early days. So economics, political science, psychology we have studied, and from economics we had commerce and economics and management, and ultimately we are now today studying this behavioral finance. So most of this economics, political science and psychology, they just got demerged from the same entity, and from economics we had commerce and economics and management, and now from commerce and economics also we have several branches like marketing, finance, HR, production, so and so forth, accounting. So this compartmentalization is going on, but this compartmentalization is just for the sake of understanding the subject easily and with clarity, not for making the subject confusion. And at one point of time, like those who are the senior professors, and they must agree with me that if you just continue to study certain discipline or certain things, at one point of time all these disciplines, whether commerce or economics or political science or psychology, even physics, they got merged. They got there is a confluence of all the disciplines at certain point of time. Now, mixing of psychology with economics, as I told that Daniel Kahneman in the year 2002 got a Nobel Prize of Economics for his work on prospect theory. So in the modern economics, the first notable work of mixing psychology with economics we found with the work of Daniel Kahneman, and second, Nobel laureate Richard Thaler in the year 2017 for his theory, his theory given by on nudge theory, for his nudge theory. Now, having understood this behavioral finance, now there are a lot of criticisms of behavioral finance. The biggest criticism is that the critics of behavioral finance, they say that this is just only a assimilation of certain anomalies. Behavioral finance is just to study certain anomalies, and it is behavioral finance. So with this respect, I just would like to say that behavioral finance is a collection of anomalies. That's true, and these anomalies are the result of imperfections or the failure of traditional finance. This failure, traditional finance, they could not study these anomalies, and they could not find answer to all these anomalies, and that's why we have all these anomalies. Inapplicable to market situations. Even traditional finance theories are not able to predict the market. Then why are we blaming behavioral finance? At least in behavioral finance, we are trying to study the current trend in the market, and why this market, and what sociological and psychological and emotional aspects are affecting this market situation. So this blame is also not true. If it is inapplicable to the market situation, so is true for the traditional financial theories. So at least we are ahead of them. Then limitations of experimental and survey based technique. My dear friends, every discipline have certain technique, certain methodology of their research. Some disciplines, they go for the observation method, some go for this archival research, some go for survey based method, some go for some laboratory based research. In behavioral finance, we have this experimental and survey based technique to a large extent, but this is the beginning only. Maybe in the days to come, we may have some other methodology, we may have some other techniques in behavioral finance, and we will be able to find answer to this limitation also. But this is not a limitation. Since this is just the beginning of behavioral finance, that's why we are finding a lot of experiment and lot of survey based techniques in behavioral finance. This is having weak empirical evidence. Again, we are comparing a 50-year-old person with a very young child. Young child, this behavioral finance is a young child, and it cannot be compared with a full grown up discipline like economics or traditional finance. We cannot. And too much emphasis on individual irrationality. It is giving too much of emphasis on individual irrationality, but this is the reality that individuals, they behave not in a rational manner. I will not say here irrational also, but their rationality is biased towards certain things, certain emotions, certain psychology. Here just I would like to play one. Is audio clear?
Yes, sir, very much clear.
Yes, sir.
Yeah.
Yes, sir.
So,
Yes.
yeah, so now if you just see this individual irrationality, now who is irrational? Whether the person who is buying that building, he was irrational, or the person who was selling that building, who was irrational. Both of them were having different set of information. Both of them having different set of emotions. अगर आप इस बिल्डिंग के 10 लाख रुपए भी और मांगते तो मैं दे देता. So he was also thinking that he has optimized, he had done a very profitable deal. The other person, he is thinking that he has made money, almost he has charged 2 lakh more amount than what it would have been. This is the crux of this rational behavior or irrational behavior. More weight is on attitude than an investment system. Just now we have seen, like in stock market, though we are trying to have, we believe we are teaching our students, we are lot of institutes are there to teach portfolio management or investment system or security analysis, but ultimately those who invest in the stock market, not only stock market, whether it is a real estate market or you are buying an agricultural plot, ultimately it is the attitude of that person, and most importantly, more than the attitude, the gut feeling and the intuition that person have an important role to play in deciding their investment pattern and behavior than that entire all this number system and this number crunching. Just now we have seen a web series Scam 1992 where one dialogue was risk hai to isk hai. It was the same system since in 1991 and everybody was just following the same trend and was part of the same system, but ultimately it was the Harshad Mehta who was trying to see the opportunity in the same system, and he was able to make so much of the money out of that system only, and it was just because of his attitude towards the system he was able to all those things. And today at least we should be thankful to Harshad Mehta that he had highlighted all those loopholes in the system, and because of that our stock market, at least our capital market, is so strong in the world, not only in India, and we must be proud of ourselves that Indian stock market is by no means we are to be considered as an underdeveloped economy or developing economy so far as this stock market is concerned. And credit goes to Harshad Mehta that he had highlighted so much of the loopholes in the system so that government was able to work upon it. And arguments in favor of behavioral finance, so absence of behavioral CAPM is always there. Later on pharma could came up with behavioral CAPM, and validity of efficient market hypothesis and investor rationality is questionable. Already we have discussed. Investors make systematic mental mistakes. Already we have seen in the stories. And this is how this entire behavioral finance is there. There are certain theories. We can discuss all the theories sometime later on. Like there is no specific theory in behavioral finance, but the theories from other disciplines like psychology and anthropology and economics we had adopted, and we are trying to translate it in the context of behavioral finance. So some of the theories are like prospect theory, nudge theory, regret theory, anchoring, disposition effect, mental accounting, overreaction, overconfidence, gambler's fallacy, hard behavior. Almost 150 investment biases are there. All these things are to be studied in the area called behavioral finance, and those who are the research scholars or who are in the early phase of their PhD degree or in the they are preparing their research proposal, you can just took any of this theory like disposition effect, you can work upon. You can took up mental accounting, how do this overreaction is there, overconfidence, hard behavior, all these things can be studied. For this hard behavior, you need not to only rely on the primary data, rather you can collect secondary data, and one tool is there, CSSD, cross-sectional standard deviation. With that also you can calculate the amount of harding in the system. For overreaction, that also with the primary data also you can do, with the secondary data also you can do. Just you have to do one technique called event study. So you just collect certain just perform that event study, certain events you have to identify, and just based on that particular event you can perform events there, find out the quantum of overreaction or underreaction in the economy. Disposition effect also, primary data, secondary data, both can be taken. For nudge theory also, this is actually very new field, and of late lot of researches are there. So those who are yet to finalize their topic, nudge theory can be taken up by you, because it is actually got highlighted in the year 2017 only. So at least in India, not very too much of the studies have been conducted in the area of nudge theory. So for the researchers, you can study any of the investment biases. There are now Bhawal sir will be explaining almost 147 investment biases are there. So out of 150 investment biases, you can do any of the investment biases. Empirical testing of all these theories are there. Those theories can be empirically tested. You can have a study on personality and investment, sentiment analysis. There is a tool now. There is one software through which you can just perform sentiment analysis. And what we can do, just we have to scrap the Twitter or the Facebook data, and from that you can identify the sentiments with respect to the investment. Data mining from the social media, again the same thing, certain tools are there. One algorithm is there like a priori algorithm, and with using that algorithm you can just find out what actually is going on in the social media, Facebook or Twitter, and from that you can just try to find out the future of stock market or any market. Adaptation of fintech is a new thing nowadays. to what extent people are actually adapting to the fintech, financial technology, awareness about fintech, and of late neurofinance, which Bawal sir will be talking about in neurofinance as well. So these are some of the upcoming areas for those research scholars who are yet to finalize their proposal or who are in the very early phase of their PhD. You can think of any of these tools and topics, and you can just redesign or give a shape to your PhD thesis. Or like those for senior researchers also, you can take up an independent study, you can publish your papers in some very good journals. So this is all from my side. Thank you for your patient listening. Now if you have any question, please feel free to ask.